Thank you, Gordy, and good morning, everyone. So, for the year that's just been, our underlying profit of $227 million is an increase of 11.5% on last year. The big driver being new sale gains, which were up 50% to $86 million. Our reported profit, or IFRS profit, which includes unrealised fair value gains on investment property, was $326 million, $62.2 million less than last year. The reason for this drop is that last year's result was boosted by changes to the independent valuation assumptions. As I explained at our half-year result, in the year to 31 March 2018, CBRE, who are our independent valuers, lifted our 5-year plus long-term growth rates from 2.8% to 3.4%. So the valuation gain of $102 million this year is due to us adding 414 new units, and also due to pricing increases of 4.2%, which continues to reflect strong demand for our village offering. Our operating cash flows are $401 million, and they are up 15%. So we've benefited from cash collections at some of our high-value sites during the half. And for the first time, our cash receipts from residents exceeded $1 billion in the year. So what this means is we had strong cash flows throughout the year, and this allowed us to invest $552 million in new villages and care centres. We've done this as follows. We invested $430 million building new villages, $55 million on land, with the land bank lifting to over 7,000 units and beds. We invested $33 million in upgrading our existing villages, and another $35 million on a range of projects, including IT infrastructure, new care hubs, and further development of Ryman. I've already talked about the lift in the valuation of our retirement village units, but on top of this, we also performed our aged care facilities valuation this year as part of our 2-yearly cycle, and their value lifted by $24.5 million in the year. This increase goes directly to our reserves, so it doesn't have a profit impact in the current year. With such a major investment during the year, our working capital has increased to $1.3 billion. We regard it as productive debt, and we use it to invest the bulk of it in new villages, where we recycle capital and which establish a growing tail of recurring cash flows. We have a very strong financial position, with total assets of $6.6 billion, up 15% on last year, and shareholder equity has lifted by 12% to $2.2 billion compared to this time last year. We continue to have very supportive banking partners, and they understand our growth plans and strongly support us. Our debt to debt plus equity ratio is 38%, so that's just 1% up from September this year. We also increased our bank facility this year to $1.7 billion and introduced the Bank of China to our syndicate. We also now have 95% of our facility at 3 or more years of tenure. Our gross development margin for the year was 30%, and this is higher than our target range of 20 to 25%. This is a direct result of Nellie Melba in Victoria, which is a high margin site. However, it's also along with Devonport and Linfield in Auckland, which are also turning out to be very strong margin sites. The resale bank of gains still to come currently stands at $885 million. So these pent-up gains mean we can expect resale earnings to keep on growing even if the housing market was flat for several years, because volumes at our villages will increase as villages mature. Deferred management fees also reset to new price levels with each resale, so this creates a compounding effect. As David touched on earlier, demand remains strong, with only 69 units or 1% of our portfolio available for resale at the end of the year. This represents only really 1 month's trading stock for us. And on top of that, care demand was also very high, as we closed the year with occupancy at 97%. And when you compare this to the sector in general, which is averaging around 87%, it's a very good outcome, and we're significantly outperforming the market. We also finished the year with pre-sales at our new villages of 148 million. Affordability of our units is also something we monitor closely, and our residents in Auckland and Melbourne continue to free up significant amounts of capital when they move into a Ryman village. In fact, property prices in Auckland would have to drop a further 15% before residents stop freeing up capital, and 25% in Melbourne. We also have the largest service department portfolio in the sector, with approximately 30% of our retirement village portfolio being service departments, which are a purely needs-based decision. What triggers our ability to grow is simple. It's our model of recycling capital at each village. Since listing in 1999 and raising 25 million, we have now invested $3.7 billion in our portfolio. And we've paid out a growing dividend stream to shareholders of more than 800 million, and we've never had to raise any new capital. And looking forward, we've managed now to lift our underlying profit and increased our dividend every year for 17 years, which is a very rare feat by any company. And we're determined to keep that track record going. And we see the growth in the future coming for four main reasons. First, we continue to have strong demand, with only 1% of our resale stock available and 97% occupancy at our established care centres. Secondly, we have secured our 10th site in Victoria, which keeps us on track to continue to grow there, and also to have our 5 villages open by the end of 2020. Thirdly, we have lifted our land bank by 18%, with more than 7,000 beds and units at 20 villages planned. And finally, our build rate is lifting, with 12 sites targeted to be under construction in the coming year. So thank you very much, and I'll now hand back to David.